2022 was a remarkably destructive year for fixed income. Returns were quite poor by any historical standard, and that was really driven by two factors. The first was inflation rising above long-term averages and long-term sustainable levels and staying there, but also, and importantly, the Federal Reserve's aggressive reaction to address that and raise interest rates in an aggressive manner. And those two things really pushed interest rates higher and bond prices lower to a degree that we haven't seen in 40 years. The good news for 2023 is that fixed income has its last name back, meaning yields are higher. There's really income to be earned. If we look back at the period post the great financial crisis in 2008, yields have been at very low levels for a long time, which is great for borrowers, but not great for bond investors trying to earn income. Given the Fed's fight against inflation, yields have reset to levels that now provide income for investors and much more attractive total return opportunities. I think fixed income investors need to be thinking about tail risk. In this environment of slowing economic growth and higher interest rates, the most vulnerable borrowers will be potentially exposed. And so those could be the consumers that have a little bit too much leverage and are no longer receiving those government stimulus payments that they benefited from during the pandemic. That could also be those companies that maybe could survive at 3 or 4% interest rates, but are going to struggle at 8 or 9% interest rates. And if we can very carefully mitigate those risks, we can find value in the market. But those companies and those issuers in particular could really, really struggle, and bond investors are going to have to be very careful going forward. I think recession fears are real. There's reason to be concerned that after a central bank has raised interest rates to the degree that it has, that we could see a recession. That's also an environment often where inflation pressures come down and high quality fixed income, and I would stress high quality, tends to do actually quite well. So I would expect that after such a poor year for treasury bonds and high quality bonds, that they could do significantly better in a recession environment. The caveat is credit risk would do a lot more poorly. And so if you look at high yield securities and potentially the riskier ends of emerging markets, those are areas that could struggle if we see that economic change. In 2022, we started to see tremendous differentiation across international markets. And that really exacerbated two things. One is the weakness and pressure in Europe, which is coming directly from energy markets and the conflict between Russia and Ukraine. That has driven European markets to price in a much weaker economic environment. And as a result of that, credit spreads or risk premiums are much wider in Europe. This has put us in a position where we actually think investment grade companies in Europe are very attractive and probably more attractive than their US counterparts at this point in time. The other area where we've seen tremendous differentiation is in emerging markets, but that's also differentiated, I would say, the strong from the weak hands from a fiscal perspective. Those economies that can benefit from higher energy prices can really manage their economic growth and fiscal profile much more smoothly in this environment, while those that are significantly under pressure from importing that inflation are really struggling, and we have to be very, very careful to avoid those riskier balance sheets in emerging markets. While I might have a sense of caution on the economic outlook, I have a tremendous sense of optimism for future returns in the bond market. At the end of the day, investors have a return that they need to meet their financial goals. For decades, perhaps longer, it was difficult to meet that return need in fixed income, or particularly high quality fixed income. I've talked to a lot of investors who suggest that's changed dramatically. Now they can earn 5 to 7% in fixed income, and that can really help provide the income and the return that they need to fund retirement goals or corporate spending goals. And so I think in an environment of higher yield, fixed income can play a larger role in portfolios, certainly, than it has done in the last 10 years. What I love about our team is it's a global team And if you pick up the Wall Street Journal on any day of the week and look at any headline on the front page, there is an analyst somewhere around the globe at our company who that is the most important thing for them today, and they can translate and identify how that creates risk or opportunity in a bond portfolio. What makes us different is the resources we have and the global collaboration that brings that together to translate risk and headline into real investable opportunity. The strength of us being a globally connected company comes to the fore when we can translate, for example, a monetary policy change in China that can create a shift in demand for products that are manufactured in Europe and then shipped to the United States. And we can follow that supply chain, and analysts can talk to each other and help identify where in the value chain we might find bottlenecks and where we can find opportunities to make money. At Columbia Threadneedle Investments, research intensity is central to what we do. Our value proposition is that we will not buy any bond if it's not fully endorsed and underwritten by our credit research team. All of the bonds that we underwrite go through a rigorous research process with a proprietary risk rating system, which gives us confidence in the cash flow sustainability of the borrower. And that puts us in a position, we think, to succeed in an environment of potential economic volatility. I don't think there's anyone that's positioned quite the way we are with the deep bench of experienced professionals that we have researching credit markets globally, and the ability to put that together into client portfolios in a way that will have a real impact on total returns. We are sized for success in the view that if you look at the amount of assets that we manage, it's large enough to afford us this deep research team, but it's also small enough such that we can buy a significant amount of securities and have them have an impact in portfolios in the right size.